Hello, and welcome to Trestlebridge Capital's new series, Get to Know Us. Before we begin, a quick note from our legal team. Today's discussion is hosted by Eric Jefferson, Managing Partner of Trestlebridge Capital. Let's get started.
Welcome to the first installment of our Getting to Know Us series. This is where we go into a little more detail on our process and the service that we deliver to clients. Recently, we were asked by someone who has referred to us whether or not we incorporate holistic planning. And I had to chuckle because words like holistic and comprehensive planning have become somewhat of industry buzzwords as of late. Candidly, it's hard to find an advisor today who doesn't offer either. That being said, through my experience, learned that can have multiple interpretations depending upon whom you speak with. Nonetheless, the question made me realize there's an opportunity to better communicate how we approach planning, what that ultimately means for clients, and how it adapts as life evolves. On your screen here, you'll see our menu of services. This is a checklist that we use for every client internally once we've had a chance to understand their priorities, their circumstances, and expectations for the future. At the top of the page, we outline the key aspects of wealth management. Those go beyond just investments and planning for retirement to think about optimizing cash flow, ensuring the right protections are in place, mitigating taxes, as well as family wealth, and ensuring that your assets are there to support the friends and organizations you care about the most. Outlined in the columns below, there we include specific techniques or strategies that we may introduce, if applicable, to a particular client circumstance. Now, obviously, not everything listed there will apply to every client. That will certainly vary depending upon your goals, your stage of life. The purpose, though, in sharing all of this, really to give you a clearer picture on what goes into our recommendations, as well as how those recommendations adapt over time as your needs and priorities change. Now, the next step when we put this all together, we use a financial planning tool, eMoney. This allows us to capture all the relevant details that we've gone through in our data gathering. More importantly, though, to illustrate various scenarios. So as life changes, being able to calculate and anticipate what is possible, what is required based upon everything a client has in place. I want to give a brief illustration here. We have some sample clients, Sarah and Michael Brown. We have their two children. We go through their goals, looking to pay for college, looking to retire. Here we've calculated or aggregated all of their net worth. We'll use some conservative projections to inflate those future account values as well on the income and the expense side of the equation. We'll also look at what they're currently contributing into those various vehicles, and lastly, what protection they have in place. What this allows us to do, go back to a client, illustrate where they are, and if there are areas need to make tweaks, can quantify the impact of doing so. So in a base case here, you have the bar graph there represents their cash flow through age 95. The different color bars represent how that cash flow is paid for or where it comes from. As they're working, you see that income represented in blue. As they then get into retirement, combination of Social Security and drawing down their qualified and non-qualified accounts. Obviously, part of the strategy or approach with this tool, based upon changing tax conditions, we can craft a strategy each year, every year, that is going to optimize tax efficiency. Now, in this scenario, you can see clients are on very good track, projecting total assets left over at age 95 of over $4.5 million. That also gives a probability of success of 95%. Now, as we think about what are some of those like-to-have things in life, they had talked about wanting to own a Cape House at some point in the next 10 years. You can see that illustrated there. As well, would like to do some significant travel in the first decade of retirement. Obviously, in real time, as we are turning on some of these additional expenses, you can see that cost reflected both in the probability of success as well as then as what left over at age 95. They've also talked about wanting to potentially retire a little sooner. And as we do that third piece there, you can see, unfortunately, that's not eligible or realistic based upon what they have in place. We can illustrate what does possibly 3 years of consulting look like to help subsidize some of those costs. Again, in this scenario, that's well beneath the threshold we would be comfortable with. So we'd have to then look at what are some of the changes we could make to make that realistic. Now, in this case, we're using some relatively conservative return assumptions. That's a function of how they may be positioned today. Realistically, if we tweak their allocations to have more of a growth component to it, that is something you can see continues to improve the potential returns, but the end of the day, not going to get us quite there. I can illustrate another scenario of renting out that Cape House for a few years, offsetting some of that cost, and you can see that now gets us back into that 99% probability of success. One of the things we also do with this tool, we'll go through and look at what is a worst case scenario. There are a lot of things that we're able to control. Granted, there's a handful that we're not. And so when we think about things like inflation, long-term average, that remained closer to 3% versus the 2 historically. What impact would that have? Social Security, when we also think about the fiscal trajectory of our country, we continue to spend more than we take in via tax and tariff revenue. In that scenario, if cuts had to be made down the road, in this case we're illustrating what a 75% cut may look like. We can see clients in this case still on track right at that 80% threshold. If we also looked at what higher taxes may entail, you can see that starts to erode the confidence in what they're going to be able to do. At the end of the day, this is a tool where we can illustrate an infinite number of scenarios. Part of the reason we've partnered with eMoney because of this exact feature. Again, it's easy to do financial planning on a napkin. That being said, life doesn't happen in a straight line. We would argue that your plan should evolve and be dynamic with your changing conditions. The last piece we can illustrate here, we talk about planning for the future, preparing for the unexpected. And in this case, we look at what impact if long-term care coverage was ever needed. Additionally, this is something that allows us to ensure protection is in place. So again, preparing for those unforeseen events should they occur. Additionally, have the option to come in and look at, if God forbid, what happened if there was a premature death. In this case, Scott unfortunately passes in the next year. You can see that has a drastic impact on their plan. That's a function of not having the right insurance in place. So we think about not only positioning assets, not only optimizing cash flows, but making sure that your future is protected against the likely and even unforeseen events that could occur. I hope this was helpful. Appreciate everyone taking a few minutes to get to know us a little better. And as always, happy to answer any questions. Thanks again.